Welcome back to the Crypto Report, everybody. I am Crypto Kip, and this is the moment that we've all been waiting for. Bitcoin has been very scary. I know your altcoins bleeding. Some people asking me, Stacks, what's going on with Stacks? For the record, I am also getting crushed in my Stacks positions, my meme coins especially. But, folks, I was not here for a week. I'm not here until next week. I'm not here until just next month, guys. I am here through the bull market. And this has been a bull market so far. We've got more bull market left, but there's fear of a 6 to 12 month cool off from some people that I'm seeing out there. Now, I'm not going to tell you that that is not possible. But if you think about what's going on right now, there is more reasons than ever before for cryptocurrency to be bullish. The Bitcoin halving is behind us. Sure, we see a 30 to 50% crash at or around the Bitcoin halving. And right now we're down 22%. Actually, less than that. We're coming up right now as we're live ahead of this FOMC meeting today. But what I'm going to do for you guys today is live stream that FOMC meeting for you. Welcome back to the Crypto Report, everybody. I am Crypto Kip, and we've got a lot to talk about today. Now, I've got the old split screen-a-rooney up for you. That's right. Today is the day for the split screen, and I'm going to go ahead and, for this video, try to make my face a little bit smaller for you guys. Let's see if I can get this situated here. So today, Bitcoin has been struggling, buggling, but we are getting a little bit of a bounce. So we lost this range up here. We were trading from bottom 60K all the way up to the high. Bounce, 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 bounce. And we were in this channel. We broke below the channel, and so there's fear. I said, okay, well, if we break below this channel, then we could see these areas over here at around 52K, possibly as low as 50K. This was on the table, guys. It still is very much so on the table. For today, it's on the table. But it all depends on our boy, Fed Chair Jerome Powell. It all depends on the Fed, my friends. And we got to see what Fed Chair is going to say. Now, this live stream is coming up soon. You can see this is live. The audio's off on this for now. But as soon as his beautiful face pops up, we are going to go live with them. We are live right now, so smash the like button. We've got 60 viewers right now, 77 viewers, 17 likes. Smash that like button for me. I got the Cough Fam in the chat, a meme token on Cronos we've been rooting for here on our channel. I myself own quite a bit of it. The Cronos chain we've been talking about a lot, so that's been going well. In a time where the broader market has obviously been slipping. Now, let's look at Bitcoin a little bit more closely. Con Nation is here, as they say in the chat. And this is a little bottomish. It's not, we're not out of the woods, my friends. And what we got to be fearful of, and here's my prediction, okay? We're going to get the Fed to speak. And when it starts, we're probably going to climb. We're probably going to maybe resist that. And depending on what he says, if he's dovish, we're going to play the game and we're going to, kind of come back up. I think that's potentially what we're going to see if he's dovish. Now, if he's bearish or if he's hawkish, which could be bearish, then we might just dump ski. But there's still a chance that we recover off this 52K region and play some of these games. So those are kind of the two future predictions that I have here for what comes next for the price of Bitcoin as we are pumping right now going into this. And I think I'm going to make all this a little bit bigger for us because let's get a little close and personal with Bitcoin here. We want to see exactly what's going on. With Bitcoin, we're on the 15-minute candles. I think the 15-minute candles are good enough for now. We are going to be going live here at 2:30 with the FOMC meeting. As for the broader market, I wish that I could, well, I'm going to get rid of my face for a second. Because I can't figure out how to get that to work. So, for the broader market, we got 15% movers, 10% movers, 5%. The memes are moving up a little bit. Dog with hats moving up a little bit today, but it's 20% down on the week. So, you know, again, if you guys are looking at a bull market potentially occurring here, and you're bullish on crypto generally, and you're not looking at this dip over here for Bitcoin as a buying opportunity, right? You were begging for buying opportunities before, and here it is. Are you buying? If you're not buying these tokens, right? Stacks is down 23%. It was below $2. Did you buy the dip? I know one person in the chat did. Shout out to you. This is a beautiful dip and an opportunity, but it could be a trap because we might dump more if the Fed comes out and he is a hawk. Not a crow, a hawk. I don't want him to be a hawk, my friends. This is a big day. You know, I talked in my video earlier, and I know you guys can't see my face right now. I'll bring my face up later on, but I know we talked earlier about some of this. You know, a lot of people are expecting. They're still hopeful that they'll be in a position to cut rates later. If the Fed comes out and speaks along these lines, I think we can get a pump. But if he does not, then I think that people will get really scared. And honestly, guys, it could play out. It could play out either way. Let's be real. Like, inflation's bad, but I put out a poll for you guys that I want you to check out in the comment section here. We got 103 viewers, 31 likes, a $5 super chat. Skawsome. The cough lock will continue to fly. Baby. Been buying dips, staying bullish through the red. As for FOMC, thinking it will be a pause. Skawsome, thank you so much for that wonderful super chat, my friend. You're a legend. Always with the super chats, my guy. Thank you very much for the support. So I do... Look. It's going to be a pause. But it's hard to predict how the market's going to react. I put out a poll in the chat. And the poll is, are inflation problems with the US dollar good or bad for Bitcoin? Now, 68% of you guys say good. I agree with you. So the more we hear about bad inflation, technically, the higher Bitcoin should pump, right? Let's see how it plays out today, my friends. 94 viewers, 34 likes. Miller says, signed up for the Patreon, but have not been added to the Discord. Can I look into this for you? Yes. Miller, please DM me on Twitter at CryptoKipTweets, and we will get it sorted out, my friend. Thank you. Skawsome says inflation problems with the U.S. would be bad in the short term, but bullish in the long term. I agree, but Skawsome, let me challenge that. I don't understand why it wouldn't be bullish for Bitcoin right now. Especially if we're scared of hyperinflation, if we're scared of just inflation getting worse. Why isn't it just everybody gets it at this point? It's just not how it is. It's super frustrating. It's super frustrating. But we play the games. I digress. Hey, Deputy Dog. How you doing, Deputy Dog? Good to see you. We're just waiting for the Fed to go live here. He is going live at 2:30, so stay posted, guys. That is coming soon. Smash the like button in the meantime. We're just waiting on the Fed at this point. Just waiting on the old Fed chair, Jerome Powell. Jerome Powelleroni. Waiting on the guy. I would like to figure out how to shrink my face, but I don't think I can figure it out. So I don't think I need to. Look, I can just move this up here. Beautiful. So I haven't live streamed an FOMC meeting in a long time. So smash the like button if you're into it. This is a, this little W. I like to see W's. W's can be good. W's can be deceptive, but W's can be very good. Sometimes those lead to a little pump. Let's see what else we got going on. Ethereum. Trying to reclaim 3K, that would be beautiful. I was saying earlier, look, if Bitcoin dumps down, then we can expect Ethereum to at least touch the top of this triangle. Hopefully nothing more. Hopefully we don't even do that. The overall market cap, had this drawn out for a while. This could be something we see as well if Bitcoin slips. Hopefully the bleeding stops sooner rather than later. But I do believe, guys, at some point we're going to break our previous high at $3 trillion. And so, again, a broader bull market is coming for crypto, in my opinion. This is what people see with crypto. We do see bull markets after the Bitcoin halving. The Bitcoin halving is complete. Give me that bull market now, please. There we go. Better charts. Solana, trying to put a hole in the boat as well, or trying to put a plug in the boat on the hole of the boat as well. Other altcoins getting rocked. Jasmy breaking out of its wedge to the downside. Not something you want to see, Jim. Not something you want to see at all. Had this wedge drawn for a while. We are breaking down below it right now. Hopefully, if Bitcoin recovers, the Jasmy holders can get that to rip as well. Cronos coin holding strong at 12.4 cents. That's not too shabby. Ethereum really not able to hold up versus Bitcoin so far this bull cycle. At some point that could change, but we're still waiting to see that change. It's not here yet. Gonna go down to the 5-minute candles as we're getting closer. Just 8 more minutes till the Fed goes live, my friends. What will happen? You let me know what you think. I'm curious. Shy Sox fan says, if Stacks keeps falling, I'm going to buy. I think that's a great play, my friend. Making sure this water's good. Yep. Bobby asked, do you think there's going to be more downside for Stacks, or is it going to recover? Look, if Bitcoin goes down, Stacks is going to go down more, unfortunately. And this is something I warned you guys of. I told you guys that Stacks could go down 50% when I bought it. I told you I bought $22,000 worth of Stacks at $3, and it is down to $2. I did a video on it the other day. I actually don't care. Why don't I care? Because I believe that Stacks is going to be well above $10 at some point in this bull market. It is the layer 2 solution for Bitcoin DeFi. Bitcoin DeFi didn't really exist before this bull market. The Bitcoin halving is now complete. I believe more broadly that we're going to have an altcoin season eventually. Eventually, the overall market cap for crypto is going to break through its previous highs. And so, yeah, Stacks could dip. Look, if this move plays out that I've drawn, and this is just a vague line, like, I don't know, 16% crash further, Stacks could crash 30, 40 more percent. That's true. That's real, guys. That's real. But the question is are you trying to buy Stacks and sell it tomorrow, or are you trying to invest in the layer 2 solution for Bitcoin, aka Stacks, because you believe in this bull market that asset is going to perform well? When you're buying a coin like Stacks, you're not gambling, you're investing. When you're buying a meme coin, you're gambling. And then if the market cap gets big enough and the community strong enough, you could try to argue that it's investing. It's still technically gambling, but there's real inflows into those things, and we know that. So, you know, you educate yourself, you understand what you're getting into, you buy the dip on the things that you believe in, and then hopefully your bags go to the moon. At least that's the strategy, my friends. Am I right? Six more minutes till the FOMC, my friends. We are getting close. It's Summers says, how do you feel about XRP? Look, I don't like XRP because I think of it as the banker's coin, but a lot of people love it. My cousin is all in on XRP. My favorite cousin. He's all in on XRP. And if my other cousins are watching, he's only my favorite because he's closest in age. We hung out the most. Nothing against my other cousins. I love all my cousins. I got a great family. But yeah, the cousin closest to me in age in my life, he's all in on XRP. It makes me nervous. Hard to get him into Stacks or Bitcoin, for that matter. Whenever you're a maxi, whenever you think your coin is the best coin, you're in trouble. That's the truth. You need to diversify your bags. You have to, I think. And that's not financial advice, but that's what I do. I get exposure to different ecosystem, different coins, different risk levels, and so far that's playing out wonderfully for me, this bull market. So far it's going very well, very well. Michael Artezi says, Welsh has me scared. Welsh has me scared too, because I'm human, and Welsh is crashing. It's dying right now, but when I say dying, I mean the price is going down. I don't mean it's gonna die. It could. That's the whole thing with meme coins. All meme coins could go away overnight, except for like Shiba Inu and Dogecoin at this point, and any others that reach like $1 billion market cap. And the ones that make it to 100 million have a better chance of sticking around too. But and Welsh did get to 100 million, but it's down now below like 30 million, right? It's down huge, I know. But we were buying that in anticipation for a Stacks altcoin rally, and we had one. And if you didn't secure profits, then you missed your chance to secure profits in that rally. But there's a bigger rally coming, in my opinion. When the full-fledged bull market occurs, and when we get that parabolic run for the broader market cap as a whole, then your Welsh bags can come back, in theory. As long as people care about the first dog meme ever built on Bitcoin on top of the layer 2 solution called Stacks, then as Stacks goes up, after Bitcoin goes up, then Welsh could go up, hypothetically. Welsh is the first dog meme on Bitcoin, for those of you guys that don't know. We've talked about it on my channel. And so we're just talking about anything and everything until 1:30 here, 2:30 Eastern time, before this FOMC goes live. Robert Kuzumano asks, are you still bullish on Crow like you used to be? Will we reach all-time high again? I believe so, Robert. And honestly, I love the fact that the meme coin is happening. The meme coin season is happening for Cronos. That makes me more bullish on Cronos, the token. Yes, I still have 200,000 Crow myself. I am very bullish on it, my friend. I still believe that Crow could go from $2 to $5 in the next bull market. Its previous high was $1. I think we could double that at least. And that's not financial advice, but yes, I am bullish on it. John Wick, Crypto Kip, Rock, thank you. Oh, man, appreciate you, man. You're in Toronto listening in your earpiece. That's twice today you've been in my chat. Flying Tiger smashing the emojis. If you guys want to become a member on the channel like Flying Tiger, get some custom emojis, you can do so in the link down below. Get our private Discord as well. Luke, I see you, man, but respectfully, I gotta look into it before I just pull that up on the charts. Because if it's like a couple 100,000 market cap coin, I'm not pulling it up. It's just too much risk for me as a YouTuber. I gotta make sure that things aren't like rugs before. And look, I've pulled up coins that unfortunately got rugged too. I got rugged on some things this year. I'm an investor just like you guys, so I just gotta be careful. And I want to make sure I do my due diligence on anything before I pull it up. Unless I'd like heard of it and like I know a little bit about it, or it came across my radar on my own and I learned about it. I hope that's fair enough. So give me the day. I'll look at your coin and we can talk tomorrow. A lot of people talking about Stacks in the chat. Yep. Yeah, Miller, Nige Miller, go ahead and DM me on Twitter. We'll get it figured out, my brother. Sorry you're going through that. That's frustrating. We'll make you right. We'll make you right. Craig says inflation is short-term bad for crypto or for Bitcoin, but long-term good because causes people to sell in the immediate for some silly reason. The Fed needs to end, to be honest. Yeah, I agree. But long-term inflation will raise BTC. I agree. I agree with you, Craig. You're a smart man. Here we go. Here we go. All right. You ready, guys? This is what you've been waiting for. Me too. Let's go to Bitcoin. Whoa. Whew. I'm nervous, huh? What about you? I can feel it. You can cut the tension with a knife in the air. People are scared. I know it. But Bitcoin's pumping right now. Before this stream goes live, oh, they're buying. There's the man of the hour.
Good afternoon.
Good luck, everybody.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report.
It looks like
that's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly
Wow.
sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored.
or anchored,
Or anchored.
stable, roughly? Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, you know, obviously Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely.
Good to hear.
You know, our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? You know, I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things. But if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
Big question, big
So
question.
let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And
likes
we'll look
data.
at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, you know, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. I mean, is inflation, would that be the key data in making that
Thank you for that
decision?
super
Or
chat, Croaky.
could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent Has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell, Rachel Siegel
My
from the
rocket
Washington
ship.
Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we
You're not
need
gonna
to
get him to
be
say
more
he's doing
confident,
cuts.
and we've said, my colleagues and I today said,
We're going to look at the data.
we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter. And I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking,
Steve.
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. And I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are,
It's down to
those will
190.
show
It's
up
back up to 221. Did you
in
buy that
measured
dip?
housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in-housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, provide accommodation to the economy, but to...
Shorts getting squeezed.
To be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Forrest from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident.
Power to motivate. Thank you for that super chat. I appreciate that. Glad you're making money, brother.
That didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's the economy has been very hard for forecasters broadly to predict.
$60,000 coming up. That's going to be a tough level, people.
To not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal. And that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become, we're now focusing, the other goal, the employment goal, now comes back in to focus. And so we are focusing on it. And that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
He's so funny.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got you've got more supply, but those people also come in and they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again.
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive. And, our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is, and we just don't do that. I mean, you can go back and read the transcripts for every. This is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So
I'll fill you in. I see somebody tapping. We'll fill it in a sec.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy. Nancy. Sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life, go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation, and the reason why we're having this conversation, is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, you know, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets, at least, have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we will be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition, for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
You know, I said an unexpected weakening is the way I characterize it. So, you know, and I'm not going to try to define exactly what I mean by that, but, you know, it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. You know, a couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you,
Last
Mark
question.
Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
That is a wrap on that, my friends. Absolutely unbelievable. What a press conference, guys. Okay, so let's break that down a little bit. So, guys, here's what I'm taking away from that. First off, let the market show you how they feel. Now, the FOMC meeting's over. Fed chair said his piece. What we talked about before this live stream kicked off, my friends, was this. We started out and we said, okay, well, if he comes in dovish, and guys, that was pretty dovish. It was dovish to me. We said, okay, what could happen is we could kind of go up, maybe come back down, and then, test a breakthrough. Or what might happen is if he comes in hawkish, we might basically just crash down and try to bounce off this 52K region. Now, let's be real, guys. The 52K region is still in the cards, but that was a pretty good press conference. You could tell by his attitude. He's always nervous when he does this, and it seems like he's got indigestion or something because he's always clearing his throat. I know because I'm a singer. I actually had acid reflux once upon a time, so I know what he's got acid reflux. I don't think that's nerves. But no doubt he's nervous. Everybody's waiting to hear what he has to say. We're on pins and needles. And to the point of Mikey Canuck, he said in the comments section here, Powell being very smart. Reporters looking for negative sound bites so they can say Fed plans to raise rates. Instead, he is giving the press nothing to print negative about rates. Yeah, and that's what he has to be. Fed Chair Jerome Powell is like a politician of sorts where he's not going to give you a bullish or a bearish thing, a fully hawkish or a fully dovish sentence, right? You're just going to have to read between the lines. And the market says, people that are reading between the lines today is, okay, so the Fed can't really pivot anytime soon, but at least we know at this point that rate hikes aren't really a part of the conversation. Now, there was a moment there where a reporter asked him, so are rate hikes on the table? Or did you guys discuss rate hikes? And he paused and he cleared his throat. Look, of course they probably discussed it, but is he going to come out and say that they discussed it and then the reporter can take the sound bite and go, oh, Fed chair, they were considering a rate hike. Rate hikes might be coming next time. They're not considering a rate hikes. If you tell by the tone of his voice, by the things that he was saying about how he feels, we've been making progress. Inflation has significantly improved, he says. It's still not perfect. Is 3% good enough? No, he still wants to go to 2%, so he's still got a long way to go. But things are headed in the right direction. So relatively, speaking, guys, that was pretty dovish and not too shabby. And we saw Ethereum come up to 3K, and we rejected off of 3K. We're not out of the woods yet, my friends. Let's see how this thing plays out throughout the day. We are not out of the woods yet, my friends. It's very, very interesting to watch kind of what comes next. What kind of questions do you guys have? So, broadly speaking, that's my analysis off of what we just listened to. You saw me yawn a couple times. It's incredibly boring stuff. Let's be honest about it. But what we care about is he dovish? Is he hawkish? And do the prices go up? Or are the prices coming down? And for now, guys, prices are going up. Let's look at the hourly candles here. We do have a hourly red candle that just happened. We got, while he was speaking, we had green candles. And for the last now 25 minutes here, we just have the beginning of a red candle. But, too soon to say. As long as we're below 60, we got to get back above 60. Let's get back above 60, and then we can continue. As for what comes next, I think we come back up. However, technically speaking, the truth is guys, we have come down and out of this channel. The good news for us right now, again, he was dovish. That's good. Unless something crazy happens with the labor market, he's not looking to, lower the rates yet, which arguably is actually also good. There's some people that believe when the Fed pivots. Now, here's something that's interesting. Many, many people believe that when the Fed pivots, okay, which means when the Fed lowers the interest rates, many people believe that that will squash an altcoin rally. So technically, as much as you might want the interest rates to come down so you can go get a mortgage for your crypto bags, technically you don't want the Fed to pivot because that could signal a cool off potentially, according to Benjamin Cowan and some of the other people that like to. Honestly, I hate all that stuff. I hate all that. Well, quantitative easing means this for altcoins. What the heck does quantitative easing or quantitative tightening have anything to do with altcoins? In my mind, it has nothing to do. Like crow with knife. Is quantitative easing going to affect crow with knife? I don't think so, right? And arguably, if inflation's bad, people should just be going to Bitcoin anyway. The good news is, guys, is that this 4-hourly candle, and 4-hourly candles are important, got some big green hope in it. Only 34 minutes left on this 4-hourly candle, which is pretty decent. So smash the like button, everybody. Thanks for tuning in. What kind of questions you guys have? I'll do a little bit of a Q&A for you guys. Good to see a flying tiger. Shout out to Scossum. Big Daddy C. Looking scared in the chat. Uh-oh. Howdy to you, Emmy. Good to see you. Tennessee Eco Man says, Carter 1 billion equals my new boat. Maybe 10 new boats? Buy BTC is what he should say, says Tennessee Eco Man. I don't know if you guys heard it, but no, never mind. I'm not going to make the joke. Not going to make the joke. Anyway, how about this, guys? Stacks. Stacks had a red... Excuse me. Stacks had a red candle on the day. It flipped green. It's red again. We were down to $1.90 all the way back up to $2.13. Again, like I was saying in the very beginning of the stream, and don't believe me, go rewind, I like to buy the dips, and there are dips to be bought still. What else we got going on here in this chat? Stingy Monkey says, interest rates need to be hiked considerably before inflation will come down. The longer you keep stalling, the longer we suffer. They need to be hiked more? You might be right. People believe that. I don't know. Now politics is in play, right? Because the existing administration probably doesn't want them to raise those interest rates because we're risking hyperinflation. If we raise those interest rates, we are risking hyperinflation, my friends. And that's what we got to be careful of. And the longer we wait and then we start raising interest rates, the more we risk hyperinflation. And I'm aware of that. That's real. See you, Carlito. Thanks for tuning in. Take care, brother. Have a good day at work. What else is going on? WS, would you recommend the Crow coin lockup? No, I don't like that. And that's not financial advice, but that's my personal opinion. Anyway, I know there's a lot of crow and knife people out there, so I guess I'll just do this real quick. Because I know the crow fam's out there. This crow with knife token, guys, is the #1 meme on Cronos. It is unbelievable. I'm not sponsored or affiliated with them in any way, but I do own a big bag. This thing got to $100 million market cap, and it is consolidating in this bull flag. Can it break out? I do not know, but if it does, the upside looks tasty. I was watching this thing pump while we were live here. Another one, Croaky, absolutely ripping on Cronos, but that's not the only one, guys. There's so many coins that are ripping on Cronos right now. Mystery token's doing pretty well. Let's see where mystery token's at. Mystery token all green. Dip looking, bap, boop, bap, boop. Who knows? Mama says inflation is high because corporations are taking advantage to overprice and make more profit. That is definitely a factor. It started with the supply chain issues too, because that was their excuse to raise prices, and a lot of them still have yet to lower their prices to get them back within reason. Yeah, Mikey Canuck says, somehow I find it ironic that crypto now responds to Fed rates and Wall Street news. I know, isn't it ridiculous? It shouldn't. That was my first poll I did earlier in the stream. They really shouldn't. Inflation's bad. Bitcoin should go to the moon. 56% of you guys believe that the Fed just sounded crowish, which is very interesting to me. It's very interesting to me. Thank you for the super chat, user Robber. Says Mary next up. 100 million coin? I don't know. Gotta get an exchange listing. Can it do it? I don't know. Buy Crow before $1, says Croak at $3 million market cap DeFi soon. It might. You need to keep that market cap climbing. It is pumping today, that's for sure. All right, my friends. 2 live streams for you today. Waldo asks, what's the best risk to reward on Crow? Oh, I don't know what you mean by that, but I think Crow's going to do well in this bull cycle. I hope that answers your question, Waldo. Lot more upside than there is downside for Crow in my mind. This Van asks, can you elaborate more on Altcoin? How is it news related to Crow with Knife, and has there been any news from dev destruction? You still believe it'll... Yeah, I'm still bullish on Ka, and I haven't heard from Destruction, and there's a potential exchange listing coming. That's a rumor, and the FOMC meeting has nothing to do with Ka, but that price is still kind of holding strong. It's outperforming the rest of the crypto market, so we were looking at it. Oh, for the memes? Yeah. Waldo. Good question, man. What's the best risk to reward on the Cronos memes? You're putting me in a tough spot there, Waldo. I don't want to talk about some low cap ones too much. Yeah, you got it. This Van Dyke. I don't know how to say your name. Look, there's a lot of good memes on Cronos right now. Oh, man. I'll say a couple real quick. I'll tell you what I hold. I hold Ka. Its biggest holdings and smallest holdings. Ka. Croak. Crow Fam. Fortune favors the brave. Those are the only ones that I have any real tickle about that are good risk to reward. But Crow with Knives really pumped up. I do think there's new buyers coming, but $100 million market cap is pretty big. I think that you're going to get a lot of centralized entities, like people buying from centralized exchanges buying into Ka. But yeah, I mean, that's what I got anyway. Oh, I have like, I have a little bit of M&M too, because why not? Scawsome $5 super chat. It says, I moved all my Shiba and Whiff into Ka. Ka is the top meme play. Crow Flock Fly up. Scawsome's is a Ka ball. I got a little bit of M&M, because why not? I just used some of my other profits, but Waldo, there's some that, look, you got to look for the strongest community, Waldo. You gotta look for the strongest community. It's all about community with memes, and Bitcoin is slipping down. What is going on? No, don't do it, Bitcoin. Don't slip, Bitcoin. We always get these stupid scam wicks on these FOMC days for Bitcoin. Uh-oh. I told you guys that 52 is not off the table. Are we going to 52 right now? Kip means chicken in Dutch. James is up $50,000, my guy. I love it. Blessings to you, John. Blessing to you. Here we go. And Stacks is going back down, and ETH is going back down, and Solana is going back down, and Bitcoin's going back down, and I thought the Fed was dovish. I thought this was good news. All right, guys. I got 2 more videos still coming for you later today. Black Sea's going to do a little FOMC update for you guys later. We'll talk about the price action on Bitcoin later today, so be on the lookout for Black Sea's video later tonight. And then later tonight, again, I'm going to do another caw video because caw, baby, caw. That's all I got on this one. I am Crypto Kip. This is the Crypto Report. Don't forget to smash the like button. Subscribe to the channel for more crypto content. And as always, guys, don't forget to DCA and HODL. And, of course, I will see you in the next one. Thanks, everybody. Have a great night. I'll see you later. More videos later today. Peace, y'all.